Oh, welcome to the Trading Zone. I'm Joe Teague, and with me is Brian Stutland. Brian, how's it going?
Good. How you doing? How you doing?
Pretty good, pretty good. Brian, what was the best U.S. men's basketball team? Was it the Dream Team, or what's the better team? Was it the Dream Team of 1992 with Christian Laettner, Michael Jordan, and Larry Bird, and all of the above, or was it the 2024 team? Or is it just me and you? Are we the true dream team?
Well, we are the dream team trading these markets in Trading Zone here, sponsored by the MyX. Uh, Before we get into our show, which is going to be an awesome show, I will answer your question, Joe. I still think the 92 team, the dream team, is the best team only for the fact of the level of superstars. I mean, you had Michael Jordan in his prime. So, there's nothing better than that. But I will say, in terms of the diversification of the 24 team that we just saw between Curry and Durant and LeBron, like one of those three guys were going to go off in any given game and have the capabilities of do that. And look, basketball is a 5-man sport, right? So one guy, that's all you really need to win a game sometimes. And they had enough, of those one type of guys that were going to go off, even though if it was like maybe, a 1v1 matchup between the top five guys of this team versus the 92 team, I think the 92 team wins. 4 out of 5 of those 1v1 matches, but this team as a whole was very good. It was fun to watch.
Well, I can say basketball has become just way more global since then, and the games are more entertaining this go around. So they actually had real competition, and
That's true.
they got tested, and it was fun to see the American stars perform in the clutch like the Dream Team never got to.
Well, go USA. And speaking of USA, on our show today, we're talking yen, US dollar, right, Joe? Speaking of US and currencies and what's going on around the world, because obviously a lot of that is affecting the level of volatility that we're seeing in this market. And we saw the rapid unwind of the yen carry trade occur. And it's very ironic that this unwind happened literally at the same time the NASDAQ sold off from its highs. It almost felt like the Bank of Japan was unwinding, or some massive institution that had big positions on in the yen carry trade and using that as leverage to, or using their stock positions as leverage to do other things, all went into it. And certainly we saw the level of volatility that creeped in the market once that came undone.
Yeah, I don't see it as a coincidence. I see some savvy risk manager at a bank coming out in on Monday morning, Sunday night for us, and saying, wait a second, this is going against us. This is what it looks like if it goes another 20% against us. This is what happens when you shock volatility, for example. And they just ordered unwind is what I think. And they said, let's cut our losses here, not let it get much worse than it already is. So I think a savvy risk control happened. People got out. It was just a massive risk off event. And then to see that unwind so quickly is really amazing to me. It seems like, the Japanese central bank got ahead of it and said, maybe we don't need to raise rates so aggressively. And really that's undone a lot of the damage. But really, for me, it was a really quick risk off, back risk on event. Hopefully that means it's in the past. But I think that's wishful thinking saying it's in the past. I think the risks are elevated now, given that event happened. And, there were some savvy risk managers in 2007, Brian, that said, wait a second, some of these credit default swaps look bad. Let me get out of them now before it gets worse. And we had some hiccups and everyone thought it was over. And then it really got bad in the months following.
Yeah, it sure did. Look, this is going to be our big story. We'll get more into the technicals on this and some of the fundamentals behind this trade, what it meant for the market. I think when you're looking at the week ahead here, though, this is something we want to look at. And, look, the CPI number is going to be big. The unemployment report just recently was fairly big because it led to some indication that potential recession could be happening down the road if the Federal Reserve doesn't take enough action to provide liquidity. That's gotten the markets a little jittery as well, as we've seen this play a part in the whole, yen carry unwind trade, as our interest rates have headed lower and their interest rates have headed higher. But the CPI number is going to play a tail in the fact of, hey, can the Fed really afford to cut 50 basis points, which is what the market expects. So that's something I'm going to be watching.
Can I be devil's advocate here? I think
Sure.
the inflation story is kind of done. The Fed's going to cut. The market's pricing that in. For me, it's now coming back down to the economy. It's the Fed's cutting. Is the economy in a tailspin, or is the economy just in a soft slowdown? I think that's really what we're looking at. I think this inflation data is kind of, worst case scenario would be a slowing economy and too hot inflation. It doesn't seem like that's happening. You'd see like wage growth spiraling out of control. Doesn't seem like that's happening. It does seem like inflation, like the Fed has been saying, has not had that, second lift off. I think if the Fed were to cut 50 basis points and the economy does not slow down, then you might see the inflation lifting off again. But for me, it's really about the economic data, really going to be about the jobs data that's going to be driving the market. That's what I want to see. For the bulls, looking to the market go higher, I want to see these jobs losses slow down. I just want to see them come to a minimal. We expect some damage to the economy. We expect some losses, but we don't want to see disastrous numbers like we saw in July, month after month. I think that's when you're going to see recession fears popping up.
So, I mean, maybe it could be that Wednesday is not as volatile in the past as we've seen with CPI numbers, where the market's, made a, over 1% move.
We're pricing that in, though, Brian. We're pricing in a big move on these CPI numbers.
Yeah, that's right. I mean, when we were looking earlier today, Joe, we were looking at trades. We saw the at-the-money straddle in the S&P valued at about $95 on a, let's call the S&P 500 a $5,300 stock. That's still a pretty sizable move that option traders are pricing in for this week. But maybe to your point, maybe it's looking at what the Philly Fed is going to come out with, what continuing claims are going to be, and maybe we need to start.
I didn't put this on here. We also got Walmart, Brian. That's going to be critical too. Is the consumer still out there spending, or is this consumer showing signs they're slowing down, worried about their own job or worried about their spending going forward?
Yeah, that's right. So what is it that we have for this show here, Joe?
Well, let's bring it in. Yeah, bring it into the volatility zone.
Okay.
Something we talk about every week. Remember, I'm Joe Teagas, Brian Sutton, Equity Armor Investments. Thanks everyone for tuning in. If you're new to us, first time tuning in, we're former VIX options market makers. Wealth of knowledge when it comes to options trading, a unique specialty when it comes to VIX trading. Brian was one of the first 5 traders in the options pit, knows a lot about VIX trading. So keep that in mind when you're watching. Got any questions about volatility, options trading, VIX, shoot them our ways. We're happy to field them. And this is something we look at every week on this show, is just the skew. This is somewhat of a leading indicator for us when it comes to volatility. What we saw, just a massive spike on Monday and a massive unwind on this just in a week.
Yeah, we really did. And I think, obviously the spike was the level of risk in the marketplace. It was reflective. What we saw was a massive influx of downside put buyers wanting demand for the insurance protection on the downside. That's why you would buy a put relative to the amount of traders wanting to own a call. So you can kind of think of it as like that. And what we've seen, and I've talked about this, throughout the week last week, is that level of put buying subsided. It kind of came off those levels. We got some moderation, some level of volatility on the upside to the call side, which this is probably this level of shift to the puts so quickly. It's happened maybe 5 times over the last 15 years. And each time that all of a sudden it's come off those levels, the market has actually rallied, at least for the next 3 to 6 months after that. So that's at least a good sign for the market, for the bulls, seeing this level of put buying and wanting to own put volatility subside. There you have it, going over the last 5 years, Joe. As you saw before in 2020, it came off, market rallied. There's a couple other spikes in between, but this is what I call a super spike. We've seen it some other times, Joe. What do you make of it versus maybe the past?
Yeah, I mean, it wasn't like a COVID level a world is ending spike, but it was as big as any of the other spikes that we've seen over the past 5 years. And it was just a dramatic unwind of it too. And it, most importantly for me is we had just lower levels of volatility for some time from 2022 all the way up into this year. So we were going lower, lower, lower. We broke that trend. So I think that's actually a new dynamic for me. It seems like, yes, maybe the immediate danger is gone, but I think the new normal is going to be elevated volatility for me. It is important that we're also still above this level, right there, around 5-ish. So yeah, I think elevated volatility is going to be here. We were expecting this really all year long. It's been a long time coming to see this coming, but we were expecting elevated volatility in the fourth quarter, specifically around the election. So we have, we had a credit event, we had the currency crisis flaring up, and then the question is anything else coming down the line? It remains to be seen that this is just going to be exactly like all the other times, but lots of volatility coming in just a heartbeat. There was a lot of trading, a lot of price action going on. So yeah, it does make sense that some of the risk has been taken off, and we can go higher. For me, it's going to come down to the fundamentals of the economy. Are we slowing down too much, or are we, get that sweet spots where we have a slight cool down and interest rates coming down and stocks can go higher?
Yeah, and then I think when you turn the page and you look at the VIX futures curve and what that's done, it's unbelievable where it was just last week versus where it was now, and where it was just even a month ago. So again, we're back to the point where the October VIX future is trading higher than the front couple month futures, which to me is still an indication that there's a level of fear about what's going to happen around the election timeframe come November and into late October. And so that is still finding a bid, but we've obviously seen this super spike in the VIX, the futures coming well back off of where they were today. And when I'm looking at sort of a mean reversion, I think we're kind of in the middle. Could we head lower back towards where we were, let's say, a month or 2 months ago, or do we retest somewhere in between the highs of this curve last week, and before the stock market can move higher?
Yeah, I'd have to agree 100% with that. What I think the bulls want to see is like this shape. Bulls in the equities want to see this shape in the VIX futures curve, where you have the cash below the front month, below the second month, below the third month. That gives a little more confidence in the stock market. Right now, we don't have that still. We have the front month below the cash, so there is some uncertainty. We're kind of in a little middle stage, like you said. It could go either way. We could just have the VIX futures traders predicting volatility come lower over the course of the next 2 weeks. But this is kind of a dicey spot still. We're in no man's land, and we're going to see it in this trend chart, Brian. This is what we've been following all year long in this S&P 500 trend, where we had this upward trend line and then like an accelerated upward trend line, and we broke the accelerated upward trend line, and now we're kind of in this no man's land. It's still long-term positive, don't be confused, but nowhere near as bullish, and it's very shaky, to say the least, in these levels.
Yeah, it is. When you look at some of the levels here, 5,500 on the upside, call it 5,250, 5,100 on the downside. If we were to break that 5,100 mark, Joe, I think that would start to be a formation of what technical traders like to call a head and shoulders top, forming that other side of the shoulder on the head and shoulders with a neckline break that could take us very well back into that lower channel region. And then it's like, whoa, look out, 4,600, maybe next stop quickly after that. So this is going to be a critical level right here, as you're sort of outlining, is something I'm watching to see if that break happens or materializes over the next couple of weeks.
Yeah, and I think this might be something that takes course over the next couple of months even. And we still have could potentially trade up here and then lower. Anything where you get this, if this rally fizzles out and does not make a new all-time high, it could either come all the way up here and be like a double top situation. So there's a lot that can happen over the next couple of months. Lots of volatility. We're expecting a lot of volatility, but just given the chart where we're at, given where this trend is here, Question for you, Brian, as I come into our trade coming up soon. Surprise for you. Would you be a seller at 5,600?
I think it would make sense to take some level of profit. Now, when I go back and I look at, let's say, August 2007, where we kind of had this out of nowhere little spike in volatility, concern about the waning economy, or February 2018, where we were worried about interest rate hikes, we had a little Volmageddon. That led to rallies. 5,600, I think, is in the cards, given sort of this super spike that we saw, and now it's kind of come off that. However, those rallies didn't last like ongoing. There was some sort of retest following that of the area that we're at right now. So I would be willing to put some sort of trade on where I'm, going to take some profit up at those levels.
Okay. Would you be a buyer at 5,200?
I think from a risk reward perspective, I would, and I'd probably use options to do that because of the fact that I think the level of risk increases dramatically from 5,200 down to that 4,600 level. So if I'm going to own the market, I've got to find a way to control risk.
Okay, so given all that drum roll, let's see my trade which I lined up. Okay, so here's what I lined up: buying a 1x2 end of month August. By the way, so I think we're going to stay within that channel. Those two lines here. I'm going to buy a 5,400 call in August. Sell 2 5,500 calls. It's a 54, 5,500 1x2. Break even, of course, up at 5,600. I'm short the market at 5,600, so I definitely don't want to see it surpass that. And to finance that, because it does cost money, I'm actually selling the 5,200 put. Okay, so futures currently trading 5,380. For the whole trade, all 4 options collect $16 to put it on. So I will be profitable all the way down to 5,184. On the downside, and I will be most profitable at 5,500 and start to fizzle out some of those profits up into break even all the way up at 5,616.
Yeah, I like this trade for the duration portion of it, number one, because, if we're going to get these kind of moves and these levels, it's going to probably happen over the next, let's call it 3 weeks, right? So after 3 weeks go by, there's no more risk from there. After that point, though, I think when you look at it, and selling options, collecting $16 if nothing happens, okay, make a, call it 0.25% return on your money, right? But above 5,400, start making money right away. I think this is a pretty cool, interesting trade to sort of limit risk. We're kind of in this no man's land here.
By the way, I view this as like a stock replacement trade, being flat the market, but instead I have this on. Get back along the market down at 5,200. Much rather be along the market at 5,200 than 5,380. With $200, 4% lower. I think that works for me. But I also get to participate up to 5,500. And then make a little bit less, all the way up to 5,600. Essentially, I'll be profitable on this trade.
Yeah, and actually, just speaking of stock replacement, the one way I would maybe do it is where if I was long, let's say $100, I would sell $50. Keep the other 50, stay long the market, but then instead, the $50 that I sold and took as cash, I'd keep on the side and put this trade on that would repurchase $50 worth back down at 5,200 level here, because that way now from 54 to 55, I get back to my 100% exposure to the market that I wanted anyways, but I don't have to take the risk all the way down to 5,200 to get back long again. So this is almost like a stock replacement for half of a position.
Yeah, that's kind of how we think about it. If you got any questions, remember, we're here to help. We want to thank everybody for catching us live like you did. Really appreciate everyone tuning in. And it's really, really fun to talk the market with Brian every Monday.
It certainly was. This has been a great couple of weeks of Olympics. I know we started the show talking about that. The U.S. finishing tied with China for the number of gold medals, but I'm going to give them the tiebreaker because they won more overall medals and winning the Olympics. But I can't wait for it to come to L.A. in 4 years. that's going to be exciting. Joe, we might have to get out there and watch an event or two. What do you think?
Let's do it. They need a stock trading event. How do we get that going?
Well, if we have this level of volatility in the market during that time, that would definitely be a fun event to have.
We were gifted. I remember maybe there's something about the Olympics that brings some volatility. I remember Sochi was right before the first Crimea event. So there's something about the Olympics. Maybe keep in mind, put that in our calendars 4 years from now for the Los Angeles Games.
Certainly, we will mark that date 4 years from now. We will find you on this show, Joe, here as we continue on giving trades. But this has been a great show. A lot to sort of digest in terms of the yen carry trade that unwound and how we sort of make of that trade that led to the level of volatility that we saw. So let's see if we can get some things turned around here in the market. But we do have our hedges in place now, so feel pretty comfortable about where we've been at over the last few weeks here as we continue to risk manage positions. I'm Brian Stutland here of Equity Armor Investments with my colleague Joe Tigay. We'll be catching you guys here every Monday. Tune in 1 p.m. Eastern. Watch the Trading Zone here, sponsored by the MIAX. Tune in, find us on the Tradier Hub, and or social media on any of our handles. And we look forward to seeing you next week.
Have a great week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.